Eric Mwather with another mentorship video. What I did the last hour or so was look at some of the stocks you've owned over the last couple of weeks while we've been working together. And what I wanted to do is just go through the stocks and see what we can learn from them in terms of timing. And actually the one thing that you'll see that, and we see this every time I do it or anybody does it, that we need to be taking losses anywhere between 3%, even 5% is okay, and surely not more than 8%. If we can stick to this, we see that there is the chance of getting out of bad positions and the chance of getting long on some good positions and staying long on good positions. So this is the thing. The key for me when I was reviewing this is the stocks that didn't do well should have been sold for small losses and you move on. And also there's also the other argument, like let's say if you own 100 shares of stock ABC, you can set some of your stop at 3% loss and the other a third at 5% and the last chunk at 8%. Or you can say I'm going to take half at 3% stop loss and the other half at 5% stop loss. As long as you're looking at either stop on either level, because sometimes the fact that we buy and sell on bulk trades also sets up for bad prices. So I think we should, if you're able to, depending on account size and all that, is if you can split your entry into a couple of, so let's say if you wanted to buy 100 shares of a stock ABC, maybe you can buy in 2 portions of 50 each, or you can buy in portions of a third at a time, or at least 1/3 at a time. And this helps helps you not being too desperate to buy a stock, and I think it also helps you relax and also helps you psychologically because you are not being arrogant, and the market has a way of punishing us when we think that the only way we are going to make money in a stock is to buy it right here. You got to buy it right here. Otherwise, you're going to lose an opportunity. It helps you relax, and it also helps you get favorable prices if you can buy it over a period of, let's say, every 3 hours or every 4 hours to fill in your 100% entry into a position. Anyway, let's take a look at the stocks. I hope that makes sense. What I'm saying is we have to use stops, and we don't have to have one stop price for a particular position. We can have multiple levels to get stopped out. We can also have multiple levels to buy a stock instead of just buying it in one wholesale price action. But that's the key I got out of looking at the stocks you've owned over the last couple of weeks, is get out when you are wrong and hold on to your winners, and you'll see that demonstrated here. And it's something we hear all the time, and we know for a fact that hold on to your winners, get out of your losers, because they're just not gonna, if they're losing you money right off the bat, they're probably not good trades. And even if they turn around and move and make money after you get stopped out, it's okay. That's the thing. Protection is key. So let's take a look at JB Hunt, which was one of the short ideas, and this is a weekly. So I think we went short, I believe was somewhere here. And when we went short, the RSI was intra-week was trading down like that. So it looked like it was showing a reversal based on this RSI on the weekly, but it turned around during the week and headed higher. So this one should have been stopped out and was stopped out. So that's good. On the daily, I remember that we had drawn a line somewhere around there, and I believe we went short here, which was this high, and the stock did go down from the mid 70s to the lower 70s, and that either you can take a small profit at that point, but we held on and finally got stopped out somewhere here, and that's okay. Our entry was violated after the stock moved above the prior resistance line, And since then it's higher, and so there's no need to re-own it. We are not looking at this one as a short for now. We are looking at other opportunities, other ideas. But that's the summary on this one. Didn't work out, got stopped out, no big deal, move on. The other one is ERY, which I believe got stopped out. Now, remind me if I'm wrong, but got stopped out, I don't remember, but I think it was somewhere here. And if I recall, maybe I'm wrong, it never went past 8% loss. I don't think it went below 8%. Maybe it did, I don't remember, but I think this is where we got stopped out. And my thinking at the time was based on the daily that the stock was going to move higher, was based on a very simple analysis that the prior line, and I believe I drew it somewhere like that. So there was that argument, and also this argument here drawing the same line. So the stock had come back, I believe, here, and we were timing it here. Now it went up for a couple of days, rolled over again and came here and made a lower low, and I think we got stopped out, quite frankly, right there at the worst possible time. And I don't believe it violated 8%. So that's probably one thing we need to watch, is maybe we should have had three stops, one at -8, the other at -5, and maybe the other one at -3. We could have still had some position in the stock. So, and you can see what the stock did. It tricked you, or tricked us, because even though it comes here and makes a fresh low, the RSI really doesn't show any change. And you can see uniform activity below the line and back above it. So it was trying to shake us out, which it did. And since then, stock has moved from about 1650 all the way to 26. Now I call that about 70-80% in a couple of weeks. And the trick here is that the stock played games and got people out, including your positions. So it happens. But our analysis was still right, because the stock found support exactly as we had predicted on the RSI, and it moved higher. So that analysis on hindsight was correct. Another one that I look here was a short, and I believe you still own this one, is Las Vegas Sands. And I just want to take a look at the monthly, because we've been looking at this from a monthly view. Our suspicion was the stock would have a big down month when the RSI moves below 50, which is exactly what it's doing this month. So kudos there on a good trade. And we had also been looking at this on, this is now the weekly. You can see now the 10-week moving average has become resistance there. On the daily, now this one has been the break took place here off the highs, the RSI break, and just draw a simple straight line. You can see that it's been giving you short opportunities on the daily since then. And even here, even though here it was looking like it was breaking out, the RSI really never moved any much further. So the RSI, in my opinion, gives you some reason sometimes to hold on to your position, unless you are down more than 8%, then you have to take the loss maximum. But the RSI held, and since then we see that the stock has gone lower. So this one continues being on your portfolio, and for good reason, because you can see that the monthly RSI is trading at 3-year lows, which is where stocks start moving low. As you can see, it's picking up pace to the downside. Recently broke below the recent monthly closing high low there, monthly closing low at about 62. So that was another trigger point. And the MACDs are, at least one of the MACDs are trading, or is trading, below zero and making fresh monthly lows. Now if we take a look at another idea, this one was an absolute good pick, ANGO. And I remember very well that the entry point was here. We got in, or you got in somewhere here, and I remember, maybe you do, let me remind you, somewhere around here I was telling you to add on to the position, and you kept saying, are you sure, are you sure? I was saying I think so. Go ahead and add. And you did take some of that risky trade. Remember, the market was dropping in October. Here the market was down in October, so this seemed like a bad trade. And as you can see, I was seeing something on the charts, because since then, and the timing was perfect on hindsight, because the stock did move above 69.1 after that, and good enough for the stock to move from 63, 64, 65 all the way to the highs here at about 123 in about 2-3 months, if not that. And on the monthly, the reason why I liked the stock at the time is because you have this RSI looking like it was gonna start showing up at around and above 69.1. Also, so that breakout we were talking about was, let's see, I think was somewhere, was here is where we were going and looking at this as a breakout candidate. So anyway, since then the stock has done well. So even though I believe you got out, I believe you got out somewhere here, correct me if I'm wrong, in the 80s. So here we see an example of stocks that do well and are doing well can be held longer, because this is a perfect hindsight situation where we see that getting out somewhere here meant that you've left all this on the table. So again, there comes to what I've been saying. Maybe you should have sold a third of your position. Whoops. Maybe you should have sold a third of your position here, the other third somewhere along the way, maybe here, but at least you could have had some position left in the stock in case it moved higher. So we are learning here that let your winners run. You don't have to sell all your positions in one sale, because you can always split your trades into multiple chunks at a time. ALDR is one you bought, I believe, either today or yesterday. This one is one that I talked about as a breakout candidate. Seems to be doing well. The breakout was at about $20 and something, and we see that for the first time the stock is breaking out to all-time highs on the weekly, and also the RSI for the first time is moving above 69.1. That's why it has that 28% gain for the week, and had a nice consolidation here also before this breakout. I believe your entry was somewhere here. So perfect entry, and I do commend you for using the 2-day rest principle. So let me go back and make this. So let's do it. Take a look at the last 1 month daily, so we can see what we are talking about. So this makes sense. You had a daily closing high there. You had 2 days of rest below that daily closing high, and on the 4th day, which is today, the stock broke out. So you have 2 days of rest, and on the 4th day you go long. So this is a perfect example of waiting for day number 4 before going long on an instrument, especially if you are considering the stock from a daily chart perspective. So that's a good trade on your part. The next two ideas are terrible. This one, I believe we were going long here. This is a very bad position. Now the one thing I'm gonna say is maybe we should never had played around with 3 times ETFs. In fact, I am making a vow for myself that these are instruments that I can use for charting purposes, but not for trading with the real life money, because these things just don't act right. Even if at some point when the market starts dropping, they might move up 20, 30, 40% in a day, but man, I don't think they're worth the risk. So the next two ideas that you owned at some point, and here we lost a lot of money before you finally got out. I think you got out in the 20% area or somewhere around there. It was a bad trade, let's call it that. Bad trade. And they just move. They're so volatile. I mean, take a look now. You did not own this one, so let me stress this for those who are neutral. We did not own the following stock, but it just shows you how these 3 times ETFs are all over the place. The underlying instrument, of course, should be volatile, but man, how can you make any type of move on these types of instruments? I mean, these are big percentage moves, huge percentage moves. So I would say the 3 times ETFs, man, they need to be avoided. Take a look at another that we don't own, 3 times, and this is a 3-time ETF. Man, these things are just so difficult to find direction and consistency. These are huge percentage moves, unbelievable percentage moves. I would say, in truth, nobody should be trading these instruments. Yes, if you get them right, you might make a lot of money, but boy, the risk is just unbelievable. So that was a bad idea. My thinking here is totally ignore any 3 times trading ETF, especially on the short side. Now the other one also was a bad trade, and it goes back to the idea that it's a 3 times ETF, and I think I'd gone long, if I'm not wrong, somewhere here, and just got decimated. So maybe the lesson here is a good one. Avoid this 3 times ETFs. Just avoid that. That would be my call. Let's take a look at another that you owned, and it is EDZ. Now I'm not sure you got stopped out on this one, but I think just out of the way they were trading, you got frustrated because the market wasn't moving, and I can understand that. But the buy point was here. Not sure you got stopped out or got close. Maybe you did, but anyway, since then the breakout we've been expecting is taking place, and the stock is doing well. Again, 3 times. So I would say this one maybe should never have been in the portfolio anyway. Maybe we should avoid this. Maybe the most we should take on the short side is 2 times short the market. Maybe we can try those, but man, on the 3 times I would totally avoid those. So and even this one, as you know, those after it had moved above this level on the daily, which is this entry level here, draw a straight line, it finally did come and show double bottom support here, and since then from 32 it's gone all the way to $40 in about 2-3 weeks. So yes, it might have stopped you out, and it's definitely not a good trade because 3 times bear ETF, but on this average, our analysis on uniformity could have kept you in the stock once it found this double bottom support right there. Since then, it has been very successful. So I'm gonna leave you right there, and hope that kind of helps summarize some of the ideas. You've owned more and over the time period, but at least this gives you a snapshot of some of the stocks we've been playing with over the last couple of weeks. Okay, there's something I think I need to cover because I believe it's very important for you to understand. Very important. Absolutely important. And what is it? One of the reasons why I liked this stock during this breakout, and I kept pounding the table as to why I thought it was a good candidate, one of the reasons, and it's a very important reason, is because it was making new highs, or just about to make new highs, when the market was in trouble. In fact, it was breaking out as the market was going down. Whenever you find a stock that is breaking out when the market is in trouble, and the market starts showing signs of recovery, the very first group of stocks to break out when the market is on a free fall are the best stocks, and they tend to be your leadership stocks. So let me repeat that. Whenever the market is going down, let's say the market is dropping, and there's a stock or a sector, a group of stocks that is actually making new highs as the market is dropping, it suggests that if the market was to bounce and start moving higher, the stocks that were already trading at new highs are your fresh leadership, and they tend to move the farthest and the fastest. In other words, in plain speak, is whenever the market is in trouble and you see a stock breaking out and the market starts recovering, the stock is the one that needs to be owned, because it is the new crop of leadership. And leadership just means that it is going to gain the most in the shortest amount of time, because as the market slowly recovers, these stocks that were already at new highs tend to be pushed higher and higher and higher. And that's why during this period here, when the market was in a little bit of a trouble here during this month of October, I believe, this thing was taking off and breaking out. In fact, let's go and take a look at, so this is the weekly. Take a look at the SPX, S&P 500, and we're going to be taking a look at this time period in October. So S&P 500 looked like this. So let's go to the S&P 500, and in October, this is what the S&P 500 was doing, was dropping. And yet AGIO in October was stable and looked like it wanted to break out. So I suspected that since the market was in trouble and the stock was holding up very well, if the market was to find stability, then this thing would take off. So that was my reasoning. So you always want to find leadership when the markets are just coming back from serious sell-offs. I want to show you an example. I remember very well back in the day in 2009, we're going to go take a look at Netflix monthly. And let's go to Netflix. Let's go. Anyway, this will do. Oh, let me change it slightly so we can have. Give me a second here. Let me get my stuff ready. All right. So this is Netflix. Now, sometime here, beginning of 2009. Beginning of 2009, Netflix broke out. Right there, beginning of 2009. Now, when Netflix made a new high and the market was in trouble, because the market would make a low sometime in 09, March of 09. But Netflix was already trading at new highs. What that told traders who knew the secret, or traders who know what to look for, that this was a relatively outperforming instrument. And since once the market made a low in March of 09, Netflix was the leadership stock in, I believe, or one of the leadership stocks over the next couple of years. It moved from about $28 or so, $30, all the way to $300. Why? Because it was breaking out in terms of price and also in terms of the RSI holding above this resistance line while the market was in serious bear market. In fact, let's take a look at the SPX in 2009. So you can see here in 2009 the market is off its highs. So this is the highs coming into 2009. The market is trading here. Netflix was already breaking out. So there was your tell that a strong stock breaking out when the rest of the stocks in the market are in trouble tends to suggest that the stock is a leadership and it's going to gain the most over time, because as the market slowly recovers, this stock is going to be pushed higher and higher as the market recovers. So that was the key when I said, when I was pounding the table here for AGIO, because the market was in slight trouble and this stock was about to make new highs. So always find leadership when the market is in trouble. And also the reverse is true. If you want to go short, how do I explain this? If you want to go short, you'd rather go and find the weakest stocks when the market was being strong. Let me give you an idea. Let's take a look at SPX right now, S&P 500. So we can see the S&P 500 is just 1 week removed from a recent high. Okay? If you want to go short, you'd rather go short stocks like Las Vegas Sands. That's why I've been bearish on this sector. Why? Because as the market was trading at new highs, this instrument was flirting with new lows. So you flip the script. If the market is to drop and continue dropping, this instrument is going to be trading in the 40s, 30s, and the 20s. Because as the market drops and the environment becomes bearish and sour and just negative for every instrument, the worst performing instruments are going to be in trouble. That's why I've been pounding the table on stocks like this one or stocks like Yelp. Because as the market was making new highs, these instruments were already flirting with fresh lows. Take a look at a stock like, you can see here, while the market was making new lows last week, these instruments were already making fresh 52-week lows. And that's why they are dropping at a fast rate. So my point is, if you want to go short when the market is very top heavy, you want to find stocks that are already breaking down as the market was moving higher. So you flip the script when going short, just the opposite of when going long. Hope that makes sense. Eric Moore, the good luck, peace, and blessings. Woo! Yeah, I am